The Middle East is on fire. Overnight, new strikes between the US, Israel, and Iran have sent oil prices surging and global markets on edge. Oil tankers are stuck at sea, shipping routes are in chaos, and economists are warning that this could be the spark for a global recession. How did we get here? In late February 2026, President Donald Trump gave the final order for large-scale strikes on Iran, aiming to break the power of its long-standing Islamist regime after nuclear talks collapsed. The opening salvo killed Iran's supreme leader Ayatollah Ali Khamenei and several top military officials, but it did not end the conflict. Instead, the region erupted. Hezbollah rockets hit Israel. Israel moved ground forces into Lebanon, and Iranian missiles and drones struck targets across Qatar, the UAE, Kuwait, Bahrain, and even US diplomatic compounds. Within days, analysts warned that what began as a military campaign was morphing into an economic shock with global consequences. The most dramatic move came when Iran announced the closure of the Strait of Hormuz, promising to attack any ship trying to pass. Roughly 20% of the world's oil and a big share of liquefied natural gas normally flows through this narrow waterway. Ship tracking data soon showed more than 150 tankers anchored, unable or unwilling to move, as insurers began pulling war risk coverage. The choke points: Hormuz, Suez, and a shipping nightmare. The world is now facing what some experts call an unprecedented dual choke point crisis. The effective closure of the Strait of Hormuz, combined with renewed Houthi attacks threatening the Suez/Bab el-Mandeb corridor, has compromised roughly one-third of global seaborne crude oil trade at the same time. All 5 major container shipping lines, Maersk, MSC, CMA, CGM, Hapag-Lloyd, and COSCO, have suspended or halted transits through Hormuz and are rerouting around the Cape of Good Hope, adding weeks to voyage times. This doesn't just mean higher shipping costs. It means cascading delays for products and components that don't seem to have anything to do with the Middle East at all. Dubai, Doha, and Abu Dhabi, 3 critical global air cargo hubs, are also facing disruption, limiting the usual fallback option of switching urgent shipments from sea to air. Analysts warn that supply chain pain hits on a lag of 2 to 4 weeks, meaning the tankers sitting idle today are shortages and price spikes on store shelves a month from now. For businesses that depend on just-in-time inventory, this delay can be the difference between operating normally and shutting production lines. Oil prices are now flown from $80 to a possible $200. Energy markets were the first to react. As the war escalated and Hormuz traffic froze, Brent crude jumped above $80 per barrel, its highest level since mid-2025, while US benchmark WTI climbed into the mid-70s. Major oil companies and trading houses quickly suspended shipments through the strait, cutting as much as 20 million barrels per day out of global supply. Forecasts for where prices go next depend heavily on how long the disruption lasts. UBS and Barclays initially warned that Brent could move above $100 to $120 in a material disruption scenario, while Goldman Sachs and JP Morgan modeled $120 to $150 per barrel if the war is prolonged. In a worst-case scenario where Iran mines the strait and closure persists for months, Deutsche Bank's stress case pushes potential prices toward $200 per barrel. OPEC Plus has announced only modest production increases, and analysts note that the key issue is not pumping more oil, but physically moving it out of the Gulf. Alternative routes like Saudi Arabia's East-West pipeline and the UAE's Fujairah pipeline offer some relief, but can't fully replace the lost flow through Hormuz. For consumers, higher crude prices translate into rising gasoline and diesel costs, higher airline fares, and more expensive goods as transport and production costs feed through. Can the US economy hold for long? Coming into 2026, the US economy looked relatively resilient after a year of trade tensions, immigration fights, and lingering inflation. Unemployment hovered in the mid-4% range. Growth forecasts were around 2 to 2.5%, and business confidence was improving as companies began spending more on investment. Now, economists warn that the Iran war presents a new, complex risk. The US is more energy independent than in past oil shocks, but it is not immune to global price spikes that ripple through trade, supply chains, and financial markets. Higher oil prices act like a tax on consumers, squeezing household budgets and reducing money available for other spending. Capital Economics estimates that a sustained $100 oil price could add roughly 0.6 to 0.7 percentage points to global inflation. For an economy already battling elevated prices, that is the difference between steady cooling and another inflation flare-up. Is the US plunging into the same stagflation fears as the 1970s? Only word keeps coming up in commentary: stagflation. Some economists argue this is a worst-case scenario rather than the base case, pointing out that the Federal Reserve has more credibility and better tools than in the 1970s, and that the US produces much more of its own energy today. Others warn that if oil prices surge toward or above $100 and stay there, the combination of higher costs and cautious central banks could chill hiring and investment enough to tip the economy into a downturn. The Federal Reserve faces a dilemma. If it cuts interest rates to support growth while energy-driven inflation picks up, it risks undermining its inflation-fighting credibility. But if it keeps rates high to contain inflation, it could worsen job losses and amplify the slowdown triggered by the war. Former Fed officials have suggested that the conflict makes policymakers more hesitant to deliver the rate cuts that markets had expected for 2026. Europe and China emerging as new markets and supply chains. The president of the European Bank for Reconstruction and Development has already flagged the conflict as a serious risk to global growth, particularly for energy importing economies in Europe and Asia. European countries still rely heavily on imported oil and gas, and many are still adjusting to the disruptions from the war in Ukraine and past price spikes. The closure of Hormuz and threats to Suez force tankers and container ships onto longer, more expensive routes around Africa, pushing up costs for everything from fuel to food. Emerging markets that import energy and food are especially vulnerable, as higher prices and shipping costs strain currencies, widen trade deficits, and raise the risk of debt problems. Reuters reports that many personal finance experts advise sticking to long-term investment plans, avoiding panic selling and keeping an eye on overall risk exposure rather than trying to time the conflict. Yet they also emphasize building emergency savings and reducing high-interest debt given the heightened risk of economic slowdown. If you found this analysis helpful, don't forget to like, subscribe, and share this video. Thank you.